Welcome to The Explainer. Today, we're not just taking a look back at history. Nope, we are cracking open the operating manual. We're going to distill 50 years of Warren Buffett's wisdom, taken straight from his 2014 anniversary letter, into a practical playbook for professional investors.
Okay, let's just dive right in. We have to start here, with the scoreboard, because in this business, let's be honest, the numbers are the ultimate arbiter. What you're seeing is a compounded annual gain more than double the S&P 500, and sustained over half a century. This kind of long-term outperformance isn't just impressive, it's a straight-up statistical anomaly.
And then there's that overall gain, 1.8 million%. I mean, this isn't just a number on a page. It's the undeniable proof of a superior method, a set of principles that haven't just survived, but have absolutely thrived through every single market environment you can possibly imagine.
So the big question is, how did they do it? How on earth do you generate a result like that? Well, we've broken the Berkshire playbook down into 4 core parts, and each one kind of challenges a piece of conventional Wall Street wisdom. We're going to look at their capital engine, their investment filter, their structural advantage, and finally, the mindset that holds it all together.
So let's get into it, starting with the financial engine that powered this whole enterprise, the often misunderstood but absolutely critical concept of insurance float.
So, in the simplest terms, think of it as a revolving fund of other people's money that Berkshire gets to invest for its own account. But here's the kicker. If they underwrite profitably, meaning their premiums are more than their expenses and losses, they're actually paid to hold this massive pool of capital. It's better than free money.
Now, what's really fascinating here is watching that abstract idea become this tangible, colossal force. I mean, just look at that growth curve. This isn't just a number growing on a balance sheet. It's the exponential expansion of their investment fuel tank. It's what gives them all that dry powder to act decisively when great opportunities pop up.
And this quote just brilliantly illustrates the economic magic at the heart of their insurance operations. Buffett isn't being cute here, he's just stating the fundamental reality of it. This permanent, low-cost capital is really the first pillar of Berkshire's immense structural advantage.
So, okay, you've got this enormous capital engine just churning out cash. The next logical question is, what do you buy with it? Well, to answer that, Berkshire had to make a fundamental shift in its entire investment philosophy. And this is the crucial pivot, right here, heavily inspired by his partner Charlie Munger. They moved from what Buffett called cigar butt investing, finding these discarded, ugly businesses with one last free puff of value, to buying wonderful businesses at fair prices. They basically stopped picking up soggy cigar butts off the street and started buying entire cartons of the good stuff.
The very first major test of this new blueprint came back in 1972 with the acquisition of See's Candy. This was a moment that would prove the immense, long-term value of paying up for real quality.
And the results were just astounding. They paid $25 million for it, which was 3 times its tangible assets, a price that made Buffett gulp at the time. But that single investment has since generated nearly $2 billion in pre-tax earnings, all while needing only $40 million in additional capital. See's wasn't just a business, it was a cash gusher that taught Buffett a powerful, multi-billion-dollar lesson about the economics of great brands.
But even this new blueprint wasn't foolproof. The Dexter shoe deal, which Buffett himself calls his most gruesome mistake, really highlights a critical risk, especially when you're using your own stock to buy something.
See, he didn't pay cash for Dexter, he paid with Berkshire Hathaway stock. And that stock, which he traded for a business whose competitive advantage was about to completely evaporate, is today worth about $5.7 billion. That is a painful, permanent lesson on the difference between price and value, and the incredible danger of trading a wonderful asset for a mediocre one.
So this brings us to the next pillar of their advantage, the very structure of Berkshire itself. It's a conglomerate, which, for most of us in this business, is frankly a dirty word.
Now, Buffett argues that while most conglomerates absolutely earned their terrible reputation, by using overpriced stock to buy mediocre businesses in this desperate search for growth, the problem wasn't the structure, it was the intent. The Berkshire model shows that the conglomerate form, when it's used rationally, is actually an ideal vehicle for efficient capital allocation. This structure allows them to be a hyper-rational capital allocator. They can take the cash gushing from See's Candy and deploy it into a railroad or an energy company, without the emotional biases or the self-interest that so often traps a CEO into just reinvesting in their own declining industry.
And finally, none of this works without the right mindset. And that involves a radical, almost heretical, redefinition of a word we use every single day: risk.
Just think about that for a second. Your business school professors, the regulators, the financial media, they all have a pretty standard answer. But Buffett argues that their answer is just dead wrong.
I mean, this is a direct challenge to the very foundations of modern portfolio theory, which equates risk with beta, or volatility. For Buffett, a stock price bouncing around isn't the real danger. The real risk is the permanent loss of your purchasing power. The real risks, the things that truly destroy wealth over time, are behavioral. They are the unforced errors that investors make, trying to time the market, paying crazy fees, and, the most lethal of all, using leverage. These are the things that get in the way of the long-term compounding of great businesses.
Buffett loves to use this quote from his mentor, Ben Graham, to really drive the point home. The greatest enemy to your portfolio, it isn't a market crash, it isn't a recession, it's the person staring back at you from the mirror.
And really, that's the central question the Berkshire Playbook poses to all of us. It's a challenge to focus on the signal of a business's underlying performance, not the deafening noise of daily market sentiment. So, is your process designed for the long term, or is it just a reaction to the last tick of the tape?